Excellent, and we're away. Thanks everyone for joining us. This will be our last webinar for the year. We reduced the frequency back to quarterly earlier on in the year as things, I guess, settled down a little bit in terms of investment markets, not necessarily with the rest of the world. But what I was hoping to do today is just to give you a bit of an overview of what's been happening over the last year or two and what we expect for the 12 months coming up. So I guess in thinking about what's happened over the last 2 years, because really it's not just this year that we need to be looking at. It's been a case of demand and supply and the economics 101 of how the economy works. And so we've had sort of two years that have been very different, but have combined to have a really interesting impact on where we are at the moment and where we will be going. So I just wanted to, I guess, take a look at that, and then of course where to from here. Any questions you have, please, be happy to take them along the way, or if you prefer, for you to send them through at a later date. I'm sure most of you have been in these webinars before, and we've seen this housekeeping slide. Hopefully, I won't put you to sleep in 35 to 45 minutes. If you have any questions, shout out, as I mentioned. If you're having difficulty with your sound, then the trick can be to have your video off, and I see most of you have, I think, and that just opens up the bandwidth for the sound. We're recording the session as you would have heard, and that should be available on the website next week. If you want a copy or any information about this or anything else, just give us a shout. I'm more than happy to answer any questions or provide any additional information. The standard disclaimer has to be in there, and that is that this presentation is general advice, doesn't take into account your personal circumstances, and so any advice that we provide to you will always be in writing. Okay, so before we get on to what's been happening in the economy, I thought I'd just give a quick market update in terms of the returns that portfolios have been seeing for those that haven't had a review recently. And so I've just picked a portfolio of a client that I reviewed last week. And I guess, what we're seeing now is we've had 12 full months post recovery. So we've had some great returns. And if we look at the previous 12 months, it was pretty poor. If we look at a return of -1%, that's not too bad. But we did have quite a V-shaped 12 months where it shot down and then came back up. But I wanted to highlight a couple of things here. And firstly, if we look at the investments at the top, and this is just a typical portfolio that's spread across a few different investments, the returns we have at the top here are really in the lower risk area of the portfolio. And what we're seeing is pretty poor returns. As you'd expect from cash, you're getting basically nothing. It doesn't sort of happen as much these days, but I used to say that if you're walking through the shopping centre and you see the sandwich board out the front of the bank or the building society, and you look at their term deposit rates, you're going to be disappointed. I don't think they really do that anymore, and they certainly wouldn't if the term deposit rates are 0.2%. So that's where cash is at the moment, and so we don't expect anything from it. What we're getting is security. And then we've got our government bonds, our corporate bonds, our fixed income, our next step up on the risk return frontier. And that has seen very low returns and even a negative return. And we don't expect to get negative returns too often in fixed interest. But there's a lot happening at the moment with interest rates and expectations on interest rates. So we'll talk about that later. But the interesting thing with fixed interest is that the value can change, but if you've locked in and you hold the investment for the period, then you don't lose the money because you get your money back. But in the meantime, depending on what happens with rates, the value can change and that can produce a short-term negative return. In terms of property, we've had a really strong bounce back, which we'd expect. And when we look at two types of properties we look at infrastructure, which tends to be more stable, and we're looking at things like toll roads, airports, investments that are property based but tend to be a little more stable. And then we're looking at your standard property securities, and we think about things like GPT, Charlestown Square, Westfield, Stockland, Green Hills, those sort of places. And as you can expect, last year they were terrible because no one was going, and so they had to reduce the rents so that the retailers didn't go broke. Because when they did open up, they couldn't have an empty shopping centre. No one would go, and so that's bounced back quite strongly. In terms of Australian shares, and we tend to have in your portfolios, you'll tend to have a number of different funds to start with. So we don't put all the eggs in the one basket. But even within the asset class itself, like Australian shares, we'll have different styles of manager. And you've got a really great example here of one manager that tends to be a bit more based on companies that are producing good profits, and then another one where they're all about the growth in the future. And what we had over the last 12 months with so much money in the system was the companies that had those growth prospects really shot through. They shot up. They shot up, and they've performed really strongly. And obviously, we would rather this portfolio that all the money was in the 32% fund. But what we expect is that will switch, and it has. History has shown us time and time again that last year's winner is very rarely this year's winner. And a similar situation with global shares. The important point is that having a diversified portfolio means that you end up with, with a nice consistent return. And so, we can pick out ones, and we wish that all the money was in that particular fund, but the crystal ball doesn't work. And to be honest, if anyone tells you that it does, I'd be second guessing that and turning and running as fast as I could in the opposite direction. So the year in terms of investment returns has been really good. And on this particular portfolio, we would expect a return of about 6 or 7% in the long term, and it's given closer to 15. And that's just a typical portfolio that we have. Nice to see that return, given the year before was a negative return, even though it was only a slight negative return. And so it's really interesting that we've had a big difference between our shares and property funds that have performed really strongly and our lower risk assets that have struggled. And cutting to the chase, we think that it's probably going to be similar for the coming 12 months for 2022. Not as strong in terms of shares and property, but there's still going to be a divergence there. But we'll get on to why. Okay, so I just wanted to quickly look at what happened in 2020. I don't have any COVID figures to share with you. I think we've had enough of that. But I wanted to sort of split the last 2 years, 2020 and 2021, because the economies around the world were completely dislocated. And in 2020, it was a story about demand. So we had these lockdowns, and people didn't know what was going to happen. We didn't know whether everyone was going to be out of work. We didn't know whether we could actually leave the house, and for a good period there, we didn't. And so what happened was that household saving rates reached the highest levels they'd ever recorded. And so this is just showing the last sort of 10 years. But even if I went back to the 50s, we had never seen any savings at this level. And so over 21% of disposable income was being saved. And that's not good for the economy, because the economy is based on people spending money. That means that people are selling products. That means that businesses are strong. That means that people have got jobs. That means people have got money. That means that they go and buy things. That means that businesses are selling products, and around the circle goes. And so when we get to that, saving levels where they were, we've got a real issue. We've got a problem where there's a whole heap of stock that's just sitting there. Businesses are potentially closing down, and industry's devastated. And so what the government did is they said, right, well, we can't have this. We don't want a Great Depression. we have to keep things going. And so what we're going to do is we are just going to flood the economy with money. And so they did that in a couple of ways. They lowered interest rates because that's a tried and true measure of getting people to spend money, is that you give them more, they pay less on their loans. And some people will increase the amount they repay on their loans, but most won't, and they'll just leave it as it always has been, and they'll have more money. And then the government said, well, we're going to provide record levels of support payments, and so they don't provide a lot for the age pension, as I'm sure most of you would be aware. They provide even less for what we would have always called the dole, which is now called job seeker allowance. And the concern was, if people went onto job seeker allowance, they'd just lose their homes. They wouldn't be able to afford the repayments. And so the government significantly increased that support. So we had, and the government wasn't prepared to take a chance. They just flooded the economy with money because people weren't spending it. And so what we've had, as we've come into the end of 2020 and the start of 21, is we've had house prices surge. And I'm sure that you'd all be aware, if you've looked at the paper, if you've looked online, if you've seen the house down the street and it's been for sale, that the prices are phenomenal. And what we've had is a few things that have combined. We've had lower interest rates, so people can borrow more. We've had higher savings rates, so they've felt wealthier and they've been prepared to take those bigger risks. And we've also had the ability for people to work from home. And so it's not necessarily a sea change, could be the tree change, but it's no longer a thing that you have to be in the CBD of Sydney or Melbourne. You can be anywhere. And so that saw a lot of people leaving and coming to the regional areas. And that just pushed house prices through the roof. And it's still happening right now. So for the last 12 months, this actually includes the capital cities. In some areas it's higher. We've had 21% growth in property prices. And as you can see on the graph here, we haven't really, it's been a long time since we've seen anything like it. We're talking about the 1980s. And since the 2017 lows, which are around about here, we've had 30% growth from there. And that's pretty phenomenal. The interesting point there is that in 2017, we actually had the worst downturn in property for the last 40 years. And that was based on APRA changing lending restrictions. And there was a concern, and you can see here as we've got this trend up here, there was a concern that we've got a housing bubble. And so the government, through APRA, tightened the restrictions on lending, and then that pulled the brakes on the property market. The other thing that I sort of find interesting about this graph, aside from the fact that this seems almost vertical, the other thing I find interesting is that we're slowly getting into a space of more volatility in property. So when we had this steep growth in the 1980s, we didn't really have a crash. What we had was virtually no growth for 10 years. And so for quite a while, we would say, yeah, property, on the whole, property doesn't really go down a lot. It just, takes a breath for a while if it's gone up too much. But what we can sort of see is that very slowly, we're starting to get these periods where we do have those corrections, and they're a bit more pronounced. And so that's a likely outcome here, is that property prices will correct. But we'll get onto that in a minute as well. Okay, so 2021. So we had a lot of money in the system going into 2021, and demand returned. So I'm pretty certain I remember, New Year's Day, and people saying, "Good, we've finally got rid of that terrible year. thank God that's behind us. Well, we sort of had another one. But there was a lot of energy and enthusiasm and expectations, and people were back out. Lockdowns had finished, and people had money, and they were prepared to spend. But what happened? We had supply side issues. Now, if there's no demand, it doesn't matter what the supply is because no one's going to buy it anyway. But so throughout 2020, we had a lot of businesses that had this stock, and they just, it wasn't selling. In 2021, we had quite a few things that caused supply side issues and made that economic dislocation even greater. One of them was the Ever Given, and so you might remember back in March, we've got this narrow channel in the Suez Canal, and it's the trade route for connecting Asia to Europe. And we had the ship that somehow someone had a really bad day, and partly human error. I think there was possibly there was some nature's forces here as well. And over the course of a week, 369 ships were blocked, and there was $9.6 million worth of trade that was disrupted. And they've taken steps to widen that section of the canal now, but it's amazing how something like that can put a halt to so much. There was a little bit of a lighter side with a garden gnome shortage around the world, because people were spending more time in the garden during COVID, and it wasn't me. I don't have to be honest. I don't spend that much time in the garden, but there wasn't a garden gnome to be found. And I guess the great thing about the internet is that people will try and have a little bit of fun. Someone put their idea for freeing the canal with a giant cotton tip. I'm not sure whether that would have worked. And then we even had someone who suggested that they couldn't go to work because they were blocked in. It wasn't in our office, I'm pleased to say, but I doubt very much that it would have worked. On the serious side, what happened was we had a massive impact on semiconductors. And semiconductors in everything electronic. And so they're in your phone, they're in the laptop, computers, they're in cars, anything that you can think of that used to be there was a mechanic associated with it. Now it's computers. Well, this is what they're using semiconductors for. And as more people are working from home, there was more demand on having these devices. And so that resulted in prices going up. We also have, and I guess this is an extension of the Ever Given, pretty much everything that we buy, it travels from one country to another in a shipping container. It's too expensive to send things via the air. And so if we have any disruptions to that process, that flows on to the rest of the economy. And something that I think it was the Japanese brought in the late 80s, early 90s, was something called just-in-time manufacturing. And they had this idea, and it was revolutionary at the time, where they said, you know what, we don't want to operate with our factory when we're putting things together and having another 2 or 3 of those factories near us with all of the stock, because that's costly. It's costly to have that space and to have that stock there not being used. And that was the way it was always done in the past, is that you would make sure you had warehouses full of the things that you needed when you were building whatever you were building. And so this new idea was that, no, what we'll do is we'll make sure that when we get to the point of making this car, that we need the seats and the steering wheel, well, they're going to arrive within a couple of days, and they're immediately going in, so that they reduce the amount of space they need and the amount of storage. And that revolutionized manufacturing, and that was fantastic until we had issues that we've had just now, where if you're missing one thing out of that manufacturing process, well, you can't make the thing. You can't make anything. So and there's also an argument, there's a lot of people starting to think maybe we should be coming back and having manufacturing in the same country as where of the parts of where we're putting the product together, because that reduces the risk of any of these issues. But something that's happened over the last couple of months, which is phenomenal, and I've got a mate who owns a bakery and he's big on his coffee, and he was talking to me about the difficulties he was having with his distributor getting coffee beans into the country. And it came through from this. There's been issues all around the world with having containers moved. So I don't know if anyone out there has ever, had cause to check the price of a 40-foot shipping container from Asia to the US. I certainly haven't. But if we look at 2019, that would have cost you to get that on a boat. That would have cost you about 2,700 Australian dollars. And you sort of think, okay, yeah, and actually I have a brother-in-law who has moved around the world and actually had a shipping container. So he would have gone through this probably 5-10 years ago. Those prices changed pretty dramatically. In September this year, it cost $33,000 for the same container to go from Asia to the US. Absolutely phenomenal. In October, it's back down to $10,000. And the reason these prices fluctuate so much is that there are a small number of companies that have fixed contracts, and they've got their spot on the ship, and whether they fill their containers or not, that's their spot. They're paying for it. And so businesses that were not big enough to be able to commit to those contracts would buy whatever containers, whatever space was available, and their containers would go on in an auction. And so what happened in September was that if you wanted to get your container from Asia to the US, you paid $33,000 to do it. And so this is another one of the areas, one of the economic dislocations where supply has been an issue. And so speaking to the guys at one of the local sports shops here at Adamstown, there's a bowl shop at the front and a sports shop at the back. He's saying that for his football boots for next year, the best he can hope for is 50% of what he's had in the past. Some of the products he has in the bowls section, he's got them, but he's had to increase the price 20% because that's what he's been charged. He's been charged an extra 20%. That mate of mine that's got the bakery, he's had to put the prices up because he's been absorbing the price increases, but there's a limit to how long he can do that. And so, but what we're seeing is we are seeing that that pressure is starting to come down. Why is it important? Because if we have consumers with more money, we have businesses earning less, their profitability is down, and we've got increased costs. Well, there's really only one thing that's going to happen, and that's inflation. That is, those businesses are going to put their prices up. If they've just had 12, 18 months of where they've struggled to keep the doors open, and now their price, the wholesalers are charging them more, it's costing them more to get the product here. There's not as much of that product, then they're absolutely going to put their prices up. What about inflation? So inflation, the Reserve Bank for the last 30 years has had a target where they want inflation at 2 to 3%. And so this is showing inflation back to the 1950s. And what we can see here is that when that target was introduced, and we can see our little lines here, when that target was introduced, we've done a pretty good job sticking to it. We might have been a little bit higher, a little bit lower. And right here, this area right here is where we just went through the top of that. We went through the top of that band was as a result of those supply side issues. Interestingly, even when inflation was up here, and there was a lot of uncertainty and there was a lot of concern about what's happening. We had the oil crisis. We still didn't have enough concern with our to push our savings levels up like we have recently. But what the government wants is they want to hit in between this highlighted line here. And you can see there that we were well and truly below it, and that's why they pumped the economy full of money and lowered interest rates. And so that's what they do. They manipulate interest rates to try and hit that target, and that's the way that they help manage the economy. Two things that a government can do: they can change interest rates, or they can spend money. Governments don't like to spend money, and that's something that sort of changed when the Howard government came in. It became about balancing the budget and also keeping to this inflation target. And then the Reserve Bank can affect the interest rates, increase or decrease, and it can change the money supply as well. But this is what they're targeting. So what is going to happen to our interest rates? Well, New Zealand's already increased theirs. So they increased theirs, I think, about 6 weeks ago. The US are looking at increasing interest rates in September next year, but the market expects June. And so it's always interesting to see what is actually what's coming out of the government and saying, and the Federal Reserve and saying this is what we're going to do, but then what the market is pricing in is a different thing. We've got our Reserve Bank suggesting that it'll be between late 2022 and late 2023, and Governor Lowe yesterday made a statement that said he wouldn't be surprised if it wasn't until 2024. And that's interesting because the market is not thinking that at all. Our market is not thinking that. The issue that the RBA has is that they want to see wage growth and inflation. And so back on that previous slide, it just ticked above that top line, but it wants it to be there sustainably. And so our Reserve Bank is coming out and saying, no, we need to see it higher and we need to see it there for a while before we're looking at increasing interest rates. And so we could have further house price gains until then. And so we were talking about before that, that basically almost a vertical line of the growth that we've had in house prices. We could still get a little bit more before this particular run is over. But we have got something, we could be getting to an end there with house price growth. It's widely considered that the neutral rate that a Reserve Bank should have is somewhere between 2 and 4%, and we're at 0.1. So we're at crazy low levels, historically ridiculously low levels. And we've done that because we needed to keep the economy going. Now, the RBA knows that if it lifts rates by, say, 1%, and that's just to 1.1%, if it does it in a relatively short term, over 6 to 12 months, it knows its own modelling tells us that house prices could crash by 20 to 30%. And that's not something that the government wants. It's not something the RBA wants. It's not something that, look, except for your first home buyers, it's not something that anyone wants. And that could have a massive impact on the economy, socially as well as financially, with people losing their homes. Because you think about the average mortgage in New South Wales at the moment is over 700,000, and that's a hell of a lot of money to borrow. But with rates where it is, it feels achievable. The impact of increasing these rates is probably not something that most homeowners, new homeowners, understand, because for the last 30 years, interest rates have been going down. As they start to come back up, and they will, the Reserve Bank does not want to force a shock to the system. So what they're going to do, and they already have, a few weeks ago, APRA started tightening lending requirements, and the banks have got a buffer. So if you go and you want a mortgage, they'll say you've got to be able to repay a little bit more than what the interest rates are at the moment. APRA boosted that, so it's even higher. And you remember on that house price graph, the last time they did that in 2017, that's when house prices dropped. We had a 10% reduction over the 2 years. And so APRA's trying to get in quick, and they're trying to make little changes, and they're just trying to slow things down rather than have a continued skyrocketing growth and then the crash. The bank funding costs are increasing, and so that's another avenue the government has is they basically gave the banks very cheap access to money for 3 years, 18 months ago. And so that's going to increase, and the banks will pass that on. It's going to be interesting to see what banks do with their mortgages over the next 2 years. But what we won't see really, unless you're actually taking the loan out, is that it's going to get harder to get these loans. And so that's their way of saying, all right, we need to control this without necessarily just shooting interest rates up straight away. They're basically saying, right, well, we want to slow this growth. And the RBA wants to take its time. So there's one way to cope with the higher debt levels, and that's to have wage growth. So if your debt stays the same but your wages double, well, your debt's automatically more affordable. And that's what the RBA wants to see. It wants to see wage growth so that people can cope with the higher interest rates. But that's going to take some time, because with COVID, we actually had 400,000 foreign workers leave the country and go back to their home country, which left a little bit, and right now we've got some issues with filling jobs. I think I'm already pushing my time here, but I've got something on unemployment that I won't go over, which basically says that SEEK job ads are at record highs. And as the foreign workers come back in, then wages growth will slow. And so all of these things are pointing towards the Reserve Bank taking its time increasing interest rates, but the market isn't sure. And the market, in the meantime, is betting that it's going to happen sooner than that. So how does this affect you? Well, if you've got higher inflation, then you can expect higher interest rates. For retirees, getting nothing on your cash funds and term deposits, and then moving to 1%, it's not going to make a huge difference. For people who've got $700,000 loans or $1 million loans, it will make a big difference. There'll be a significant impact on their ability to contribute spending in the economy. And so I was mentioning there that the market is continually second guessing the RBA. And one of the difficulties is that the RBA tends to bring out guidance less frequently than some of the central banks around the world. And that's not great, to be honest, because if we don't hear from the Reserve Bank for a while, and data is released, then people jump to their own conclusions, and that causes a little bit of volatility, especially in those lower risk assets in the fixed income world. What we'd expect is that there's going to be a slowdown. There's still a little way for house prices to go, but there's a slowdown and then a retreat on those house prices. And specifically, if we get another 5 to 10% from here, then a 20 to 30% reduction is probably not completely off the cards, but the RBA will do absolutely everything they can to avoid that situation. Higher costs will be passed on. As I was mentioning before, if you've got excess savings, if you've got a reduction in supply, and you've got business owners that have struggled to keep food on the table, then as demand is picking back up, those costs will just immediately be passed on because the businesses can't afford to absorb them. So what does it mean about what happens with your investments? So for the next 12 months, we always look, what are the things that could stop us having a great year? We call that the negative case, and what are the things that could give us a great year? The negative case is that the lockdowns aren't over, and Singapore, even with 80% vaccination, locked down again. So that's a risk, and those lockdowns impact confidence, and governments that sometimes will say the checkbook's open, but it does get to a point where they say no, we're going to stop this now, and so there's that possibility that they just won't act as strongly. If we do have that rising inflation, then the central banks around the world could act more quickly than expected to increase interest rates, and that impacts demand and consumer confidence and business confidence, and possibly triggers a housing market crash. There's been a lot of issues in China with their property development. I'm not sure if you've read anything on Evergrande, but it is an amazingly large company with an amazingly large amount of debt. It's building cities that no one's moving into, and they're actually starting to demolish some of them. There's concern that could lead to contagion. And then the US always has to reapply to itself to increase the credit card limit, so it's debt ceiling. And depending on the politics at the time, that'll determine whether it goes up easily or whether there's an argument and it takes a little while and there's the potential for defaulting on debt. So these are the things that could sort of derail the next 12 months. But there's plenty of positives, and to be honest with you, I think that those positives outweigh these negatives. Certainly in New South Wales, our vaccination rates are phenomenal compared to some areas in Australia, but also around the world. We'll have those overseas workers return, and the wage pressure won't be there, and so the government, the RBA, will be reluctant to increase rates. Hopefully we'll have these supply side issues abate, and the prices will fall. More likely, businesses will increase their profit margins. Now, that means that you'll be paying a little bit more for some of the things you're buying, but because you're also an investor, you super funds and pension funds, you get the benefit of that. So in a sense, it's a little unfortunate that there's a widening of the haves and the have-nots there, but for our clients, they'll benefit through their portfolios. We're also got the government being really proactive, and we're not just talking about Scott Morrison here. We're talking about behind the scenes working with banks and with APRA to slow the property market as much as possible. I've just got a sign up that says participants can see my screen. I hope you've been seeing it the whole time. So the government's trying as best as it can to avoid that property crash. Fully expect the People's Bank of China to bring property development back into China. It's a big part of the economy, and also they want to be seen to be strong. And even if that means that they write off the debts of these property companies. And I guess the concerns of a slowdown seem to have peaked. We seem to be, it just seems to be a better feeling about us moving forward with our economy opening up and people getting back to work, which is a good thing. Going forward, so we think that we're going to continue to get low returns from those lower risk assets. And really what we need to do is we need to look at them as not as an area of the portfolio that's giving you great returns. We need to look at it as an area of the portfolio that's giving you stability. And so there's still a place for them in the portfolio, but we expect that shares and property will continue to outperform over the next 12 months. Probably not as well as what they've done in the previous 12 months, 20s and 30%. I would love to see them again for another 12 months, but the chances are that we won't see that again. But regardless, your portfolio is constructed with what you need. And so there is no one approach that fits every client. What we do is we've got our preferred managers. We keep an eye on them, make sure that they're doing the right thing. But the most important thing we do is we make sure that you've got the income that you need over the next few years secured in those lower risk assets, so that if the market does drop, you're not selling it from an area that's just lost money. You wait till that part of the portfolio has gone up. Okay, now I just in the 2 minutes I have left, I just wanted to give a quick office update and the communication that we have with you. The first thing is that we're reviewing our review documentation. And if you have any suggestions on what you'd like us to send out prior to your review, we'd love that feedback. We have been sending out reports the way that we send them out for over 20 years. We think that, that we try to keep it simple, and we try to show you the bottom line with how your portfolio is going. But if you do have anything that you'd like to see, then we would love to hear from you, because it's something that we want to make sure that you're getting value out of that documentation. The second thing is that we do have a client portable available to you now. I know that it won't be everyone that would like to avail themselves of this option, but it does give you the ability to see and update your personal information, and provides a document library. So we can put particular documents, advice documents, copies of wills, powers of attorney, anything that you would, that we either send to you or you would like to be stored in this particular portal. That's available to you, and it's something that we want to use more and more. But we've obviously got a wide range of clients and their ability and their keenness to adopt that technology. It also offers integration with DocuSign. So I'm not sure if anyone here has actually used DocuSign, but it's something that allows an electronic signature, and you can apply an electronic signature. Apparently that's been around for 20 years. So we were a little bit slow to the party and picked it up during COVID for clients that, we couldn't come in to see. It's incredibly quick, fast, and easy. Once you've done it once, you're an expert, and it's as long as the bank or the super fund accepts DocuSign, then it's a legally binding document. Something that yes, it's fantastic. Of course, we can still do it the old-fashioned way as well. The last thing is that we would love for our clients to switch from post to email, and it's we've always had an approach that will send out anything that doesn't have your personal information via email, and then anything that, unless you request it, of course, and then anything that has your personal information, we'll send it in the post. What we've found over the last couple of years is that the post there's often delays. Deliveries only come every second day, and we can do a lot more via email and via DocuSign than what we could before. So we are asking in reviews if you're comfortable receiving our correspondence via email, to please let us know. And we're also going to just put a request out to everyone just before Christmas, and as an encouragement, there's some sort of a prize for a few people that are drawn out. Our approach is that if we've got that information, we will send things to you via email. We will password protect. If we use the document library in the client portal, then we don't need to, because you'll have your own login to that portal. If we send it to you via email, then we'll password protect it. We'll send you a text message to let you know it's there with the password, so that the security is top notch. Yeah, we'd love to see everyone switch over, or as many people as comfortable. Okay, so that's pretty much everything I wanted to go through. We end with one of Gil's favourite quotes. Gil's managed to give himself a bit of leave before Christmas, so hopefully he's not doing too much work in the shed. I suppose if he is, the emergency department of Maitland Hospital will be on high alert. But any questions? I don't think any have come through in the chat, but no, it doesn't look like it. I guess as we sort of finish this year, we've been really happy with how the portfolios have bounced back. As we look back at some of the the stock market crashes over the last 20, 30, 40 years, that if we were going to have a market correction, a 6-week reduction and then return is fantastic. And so the year that we've had has been great to continue that on. I might just stop the share there because I think Kim might have a question.
Hi, yeah, Kim Hunter.
Hi, Kim. How you going?
Yeah, really, really good. Just a question. I'm not sure how relevant this is, but I think it's a bit relevant to me. Just very recently, I've had an employee. Well, my company, which I work for, is Ventia. They're actually about or preparing to list on the stock market, and they've made offer of share employees, or if I want to purchase some. I'm probably thinking there's no information. I think I've got a probably week or week and a half to put my interest forward. But I just wondered, had you heard much about them and what their prospects are on the stock market? And I'm thinking I probably won't be taking up that offer because, I think I'm better leaving things where they are, but I don't quite have a wad of money that I could do that with.
I haven't heard anything specifically. With the employee share plans, they can be, they all differ. And so the structure of the offer can range from simply the convenience of them acquiring the shares for you, so you don't have to pay brokerage. And then it can go all the way through to you might be able to receive some of them pre-tax, so you're effectively getting a tax deduction for the shares that you're buying. And some of them will even say that if you buy some of the shares, and we might have a former Telstra employee on the line here.
Well, I'm one of them as well.
Right. Okay. Well, you might remember that if you took up the ESOP 97 offer, then you got bonus shares.
Yeah, I did that. Yeah.
Yeah, and so it does differ a little bit on the arrangement itself. So more than happy to do a little bit of research for you. Generally speaking, for most of those offers, they look after the people right at the top, don't they?
Yeah, of course. Yeah. No, don't worry about doing any research for me because I'm pretty certain at this point in time I won't be taking it up. But I just wondered what you might have. And I've still got my Telstra shares after all this time. They're not worth much as far as price, but the dividend was a nice little petty cash twice a year.
Absolutely, yeah, and that's that's where we always end up talking about Telstra shares. Is that don't look too hard at the price because you might end in tears, but if you focus on the dividends, then it hasn't been too bad at all.
Yeah, that's correct. Yeah, and at one time when they did offer the reinvestment sort of issue, I took that up, but I don't think it didn't only lasted for one offer, and I think too many people took up the offer, and there were too many shares going on. But I did, so I'm probably not doing that, but I have invested in Harley Davidson Motorcycle Company. So that's probably more valuable than any other share market.
In shares or in an actual motorcycle?
An actual motorcycle.
Right. I think every time I walk into a JB Hi-Fi or one of these places, I think I should be getting some more shares in JB Hi-Fi. End up it'd feel a little bit better about some money coming back to me.
Yeah. Well, I hopefully the at least whole value, because I tend to do that. So. Yeah,
absolutely. Okay. If there aren't any other questions, then I guess that's everything that I wanted to go through. I hope there was some value here. I hope I didn't bore you too much. Sometimes I forget that I might find economics a little more interesting than the average person. But if you do have any other questions, please get in contact. We'll have this presentation available on the website, should be by early next week. In the meantime, have a happy Christmas and New Year. If you're lucky enough to be travelling, then take care on the roads. We'll be sending out some information about our office closure in early December, which will be the standard sort of 2 weeks between Christmas and New Year and a little bit after New Year. In the meantime, if there's anything we can help you with, please let us know.
All the best for Christmas, Chris.
Oh, thanks very much, Eddie. And to you too. And that's pretty much it. So we'll talk to you again soon. Thanks, everyone.
Okay, see ya.